What if I told you there's a loan program that doesn't care about your tax returns, doesn't ask for your W-2s, and it doesn't limit you based on how many properties that you already own? But almost no one outside of serious investors talks about it. It's called the DSCR loan. And if you're trying to build wealth through real estate, this might be one of the most powerful tools that you're not using. Hi, I'm Darren Copeland with Summit Lending, and I've been in the mortgage industry for over 20 years, and today I want to walk you through the little-known secrets of the DSCR loan and why understanding this could completely change how you think about investing. First, let's break down what a DSCR actually means. DSCR stands for Debt Service Coverage Ratio. Simple definition, the property qualifies, not you. So instead of using your personal income, a DSCR loan looks at the rental income of the property and compares it to the proposed mortgage payment. If the rent covers the payment, typically at a ratio of 1.0 or higher, the deal can work. And that's it. No tax returns. So no debt to income calculation based on your personal job. Now here's secret number one. Most real estate investors show very little taxable income because good accountants help them maximize deductions. That's smart for taxes, but it can kill you when you're trying to qualify for traditional financing. DSCR solves that problem. The lender isn't asking what you made, they're asking what the property makes, and that's a huge shift, you guys. Secret number two, you can scale faster. Traditional loans often limit how many financed properties that you can have. They scrutinize your global debt to income ratio, and every new mortgage tightens that box. So with the DSCR, as long as each property stands on its own and cash flows appropriately, you can continue to acquire as many properties that you want. That's how portfolios are built. One property at a time, each one paying for itself, and each one building equity. Secret number three, short-term rentals can qualify. In many cases, you can use projected Airbnb or VRBO income based on market data to qualify. That opens doors in vacation markets, college towns, and areas with strong short-term demand. But you have to structure it correctly. This isn't a plug-and-play loan. It requires understanding market rents, reviewing operating expenses, knowing how appraisal rent schedules work, choosing the right investor, and here's secret number four. You don't have to own the property in your personal name. Many DSCR loans allow you to close in an LLC. That means asset protection, cleaner bookkeeping, and separation between personal and business. That's how serious investors operate. So let's talk about wealth. Real wealth isn't built from flipping one house. It's built from controlled, long-term cash flowing assets. So think about this. If you buy one rental that nets $300 per month after expenses, that's $3,600 per year. If you buy 5 of those, now you're at 18 grand per year. And if you buy 10, that's $36,000 a year plus appreciation, plus they're paying the loan down for you. And don't discount the tax advantages. That's how freedom starts to form. And here's another piece that people miss. DSCR loans are often interest-only eligible. That means lower payments up front, stronger cash flow, and more flexibility in the early years of ownership. Is it right for everyone? No. But if you use it strategically, it can help investors preserve capital and expand faster. Now let me be clear. DSCR loans typically require larger down payments, often 20 to 25% down, higher credit scores, and strong property cash flow. So rates can be slightly higher than traditional conventional loans, but serious investors just don't look at rate. They look at return. If the property cash flows, it appreciates and creates long-term wealth, the interest rate becomes one piece of the equation, not the entire equation. The biggest mistake I see? People wait until they look good on paper. They wait until their tax returns show more income. Or they just wait until they feel perfect. Meanwhile, experienced investors are acquiring assets, they're building leverage, locking in rents, letting tenants pay down their mortgages. Wealth favors action, you guys, not perfection. The DSCR loan isn't a shortcut, it's a strategy tool. Used wisely, it removes friction from scaling a portfolio. Used recklessly, it can create risk. That's why guidance matters. If you're serious about building wealth through real estate, not just talking about it, let's build a plan. Not just for one property, but for 3, 5, 10. Let's analyze market rents, cash flow projections, down payment strategies, your exit strategy, your LLC structure, and many more. I'm Darren Copeland with Summit Lending, and my team and I work with investors who want to think long-term, who want to use financing as leverage, not a limitation. So if you're in Kansas City or anywhere that we're licensed in, reach out. Let's see if a DSCR loan fits your next investment. Don't just buy property, build income, build equity, and build wealth.